Okay. Oh, welcome back. Now during a break, I talked to a few students. So I think I want to say two remarks that I mentioned to the group of students, not kind of to everyone. The way we select the problem sets is if you go through all the problem sets and you do the work with assistance, which is your teammates, and also, of course, additional research where GPT is part of it and Copilot and the like, you will really have you really have tried yourself with kind of top-notch data and applications, right? In a safe environment. Safe environment because this first problem set is not distributing code to work with, although it's not true, we've done it during the lecture, but follow-up problem sets, they provide you with a code framework that one of the PhDs has been developing for their own research, and then they're cutting out a bit of stuff for you then to add in. Yeah? In that way it's a safe environment. The reason we do that is we want everyone, whenever we do coding, we want everyone to get 100%. This is maybe really strange from a university perspective, grading perspective, school perspective, right? Where we always center around, I don't know, 3.0, 2.0, whatnot. But for us, coding is very different. We have the experience that first everyone can accomplish 100% in coding, because for analytics, just sometimes tasks are too difficult or other people are more gifted, that's normal. But for coding, there's no reason to not get 100%. And second, our experience is if someone has, because we've been coding for lectures ever since 2015, and we've seen that if people have like, let's say, 18 out of 20 points, or if you scale it up, you see they have like 90%, then if they write a master thesis, they are maybe then at 75%. And if you contribute by coding, the other person you're contributing to needs you to get 100%. Because if the code is even at 99%, if you're lucky, then you find the missing 1%, or the other person does, but usually it just doesn't work then with that type of code. So therefore we really want you also to have this mindset to that going for 90% in coding is just not good enough. This is really, and therefore we want to support that as much as we can. In the past we had a software where students could resubmit problem sets as often as they wanted to. This year we did have it differently, as I said. You get this frame and you can work in teams, so there's a lot of help there. The second thing is, if you want, and I'm sure you want to be, and I and the team, we want to support you to be successful in whatever you do in the future. And already made a good decision coming to KIT if you want to study industrial engineering, because I think it's a very good program. But if you then go to industry, you will see that you need to connect this quantitative aspect with economic thinking, and then also with a good presentation. Right? It needs to be structured. People need to understand, why do you do what you do? Does it make sense? What's the punchline? I often observe students when we see them and they haven't gone through our courses, they have a little problem somewhere, which we all have when we do the coding, and they come with a computer, look at this line. You just can't, it's bad communication, right? And therefore, we want, with our experience, or let's say with my experience, since I made up the design of the problem sets, I want to help you to get excellent on the full value chain. And the value chain starts with, I need to think about what am I doing here, and why am I doing it? And then I need to do it properly, which is the coding aspect. And then it's about, I need to communicate to some external person why it makes sense what I did, and why that person should listen. Right? Because in industry, no one will listen just because you have a question. And that's the thing about having this write-up and having the presentation. It kind of, when we start from the back, the presentation helps you to work on your communication. First, that the slides are revealing the information you think of first order importance. Yeah? Think like in an elevator pitch. You have maybe 30 seconds to reveal something very important to you, which is important to you. But you need the support of someone else. That's why you pitch to that person some idea. And it's like a presentation. If the presentation, it was the question about grading. We try not to grade the presentation, right? But the presentation, let's say also the slides, they reveal a lot. Because if you're unstructured, if you copied, or if you just didn't do anything, the presentation just will show, because it will not be a smooth piece of information that takes the reader from zero up to, aha, this is what they did and why they did it. Right? And for you, and also for me, when we do coding, we are so focused on, is the semicolon right, is the parenthesis right, that we lose the big picture. And that again is then this presentation, the slides, is about the big picture. Why have I done what I did, and why do I think this is worth presenting, right? With regard to presentation, it's the same. Most likely in the bachelor's, you haven't yet had the chance to present, and that's why I don't do it in my lecture class, although I would like to give my own feedback. So I will try to give feedback based on the slides, because I think they're highly correlated with the presentation itself. So academically, at least after the bachelor thesis, you have to hold a presentation. But if you go for an internship somewhere, for example, and if you go to good firms, then the peer is very good, and you want to learn from them, and you want to contribute, and you want to be part of what they stand for. Therefore, I also think good presentation skills. I'm sure you have it, so therefore don't be scared of any way, but you will also see if you stand and you are talking about what you've done, it feels different than if you sit somewhere and you think about what you will talk about, right? And this is an experience. Once you do it 2 or 3 times, the 4th time you will be very cool. The way you talk is the way you've been thinking you will talk. Yeah? And therefore also it's a matter of giving you opportunities to practice that. I think the tutors, if they have a time to view your submissions prior to the tutorial, they would check the presentation slides and then just check, is there anything that might be of interest to the entire group? Yeah? If you think about the first problem set, it's a very open problem set, so most likely you have different types of data. Maybe you had different objectives inside the big objective of the strategic asset allocation. And the presentation, if we just pick 1 or 2 or 3, it's just about helping to share information. And I will then also look through the presentations myself and maybe share a little bit then the week after if I see something. And with seeing something, it's usually when I see something and I'm sure if I give you a comment here, it would make your presentation much more effective in the future. And that's kind of always the objective, to help you always stay at 100% independent of what you do. In the masters, the idea was born with the presentation, so the students were always happy to present. Of course, it was done in the tutorial, so I haven't seen it, but I've seen the slides, and I've never heard that someone was nervous or the like. Which is, of course, they had a bachelor thesis, they had a few internships, so they were ready to really go out and show how good they are, and therefore, when you think about in a pure mathematical class, it's all about the proofs. In the engineering class, it's about being able to apply it and to understand. And here, financial data science, we want to do everything that we need. We want to have good ideas, clean work, and a clean presentation also to reveal to the other people, which is first the peer of what have you done, what have you found, and what might be interesting for the others. With regard to guest speakers, we've kind of outsourced the guest speakers into a symposium since we're always time constrained. So where is it? Here. We have that already now in the 3rd year, so I would invite you to join. Let's just see what it does. It's on a Tuesday, June 3rd, 10 o'clock to 1:30. It's including lunch, so you get good lunch. It's at Durlacher Allee, so it's the BGV insurance. They are hosting that. And we're kind of meeting once a year. We invite students and people from industry, some from Germany, some from England, to talk about new developments in AI applied to business. Of course, it has a finance focus, but we try to be wide. So we have one presentation you see from an investment firm. They talk about the endowment investment Ansatz. It's kind of the way Yale and Harvard is investing. Then we have, that's a KIT alumni. So he also studied industrial engineering, then did a PhD in finance at KIT as well. And then they opened a firm, maybe you've heard it, some of my PhD friends work there. And then he made his own fund a few years ago. And I asked him to talk about specifically this topic because it's interesting what the industry is making out of that. And then we want to have a discussion. It's optimizing AI methods for environments of low signal to noise ratios. That's what I've mentioned in our course. Typical methods in the textbooks are for high signal to noise. We have large epsilons, so it's not the R square. This would be pretty good. I'm talking about these 0.8, 0.1 R squares out of sample. And then we have a Q&A where also students are invited to give questions. It's pretty informal, right? So we are meeting there to have a good time and to discuss. Then we have Peter Krauthausen. He's also from KIT. He studied computer science, did a PhD here in robotics, and now works in London in a startup, or I don't know whether startup is the right term, he shall say. So he talks about AI, schneller Weg zur Marktreife. Let's see what that is. I also don't know, but I'm very curious. Then we have Doug Tannenberg. He's also very interesting. He has a PhD in political science. And so he's done a lot of empirical research work in his time at university. And now he works for an audit firm as a data scientist. So the first time we had that, I also had him on the panel. He attracted most interest with his topics. I kind of did predict that because it's not so often that you get an insight on how an accounting firm, an auditing firm, auditing is the better word, how they use AI and problems they have and whatever. So we don't record that, so it's pretty open kind of what we talk there. So here it will be about, you see the title. Then we have Alexander Walter. He is working for LBBW Group part-time, and he's in our PhD program. He's responsible for this one problem set you work on with the long-short trading strategies in the big data environment. So you will see him there, I think. And he talks about die Prognosekraft optionsimpliziter Risikokennzahlen. So this is your problem set will be eine Untermenge of what he talks about. So he kind of gives you the big overview of whether or not you can generate alpha portfolios, meaning you can hedge out market risks by timing the 500 different stocks inside the S&P 500 based on their option implied informations like option implied variance, option implied skewness, kurtosis, crash risks. And then in your problem sets, we have maybe like 200, 400 measures, and then each group gets maybe 3 measures, different ones. So you again see why the presentation makes sense, because everyone looks at something else. You make the analysis, you have to complete the code, everyone has to do that. And then with the presentation is also then the chance that you inform the others about, hey, I found that, or this doesn't work. So he will talk about that. Then we have Mathis Mörke. He's a postdoc at St. Gallen. He has top A+ research in machine learning applied to finance. So we will talk about his research as well in a later part of the course. So they've been using different machine learning tools and applied to end-of-month option returns. And you will have one problem set where you will implement the same methods applied to synthetic data. Yeah, we don't want to make that too complicated. So, and he will talk about, I asked him to talk about new developments in academic research that might spill over to industry, so that also then the industry people who are in the room. And I think it's good for networking. We had last time, we had like the entire board of the Karlsruher big firms. ENBW was there, and I forgot, I don't check all of that, but sometimes I look in the Excel sheet. And so this was good. We had good coverage. Okay, and then we have a Best Thesis Award, but that's not of your concern here right now. And then at 1:30 we have a lunch. It's all free of charge, right? And it's just next door. So if you want to come, just send an email to Ms. Lautenschläger, and then she will register you, and then you can join. Okay. And when you observe how the guys present, you will see that these are quants / techies, but the way they present is very qualitative. So you can learn by observing, because you kind of see they have a very good way of presenting in an intuitive way, and that's also what we want to teach you with the problem sets, the write-up, and the presentations. That you also kind of learn to become confident and comfortable in talking about what you have been doing, and maybe answer a question, one or two. At first students get nervous usually, but the more experience you have, the more you are happy about questions. I can tell you an anecdote from the US interviews. When we went, it was with regard to academic interviews, but it can't be different in industry. There was a saying then, the worst interviews are the one where no one asks a question. Because people are basically then too polite, and they kind of realize it's no point in confronting you with something. While the best interviews are the ones where you have a really heated, still friendly, of course, discussion, because that really kind of shows that you are revealing information they really care about. They give you questions which you answer well, so they really think, okay, I can give them even another question. Maybe they help me to understand something better. So therefore, in that sense, if you get questions, it's a very good sign if you are prepared, right? But if you're not prepared, then that's why then the room usually then gets very quiet and the interview was not successful. Okay, so now the next problem I want to talk about is, as it appears, you've mentioned we haven't yet done Fama-French, so then I think I'm introducing that through this little problem set. So the CAPM got into academia in the late 1960s. And people have then been running regressions like we've been running now. And then PhD students, was usually at University of Chicago, they just started to generalize that. So they've been asking, why not include other factors that help to predict? Because the CAPM is just a theory, the S&P return is just a proxy for the market portfolio. In theory, you should include all tradable and non-tradable assets. And so they just started to do what we now call model selection, or I don't know, however you call this entire supervised learning environment. But keep in mind here, these are mapping regressions, T on T, so it's not yet as a regression. But then Fama-French 3, in the early 1990s, been writing a paper which relied on research also their PhD students had been doing. PhD students of Chicago often went to industry and create and start up firms, which are still very prominent nowadays. So therefore, kind of, if you want to see what's state of the art in finance, you can also look what's Chicago doing, Wharton, Stanford, Columbia, MIT. But if I had to pick one, then I would go for Chicago, and I would just check what do they teach and what do they do research on and the like. With regard to investments. So this may be the best investments type university. And what the Fama-French regression, if you just look at it, does, it's simply extending the linear regression model by 2 additional factors. Why? Because I just call it data mining, which is probably the wrong word, but to relate to you who want to do data science, most likely by data mining, they kind of figured out there are two additional factors that increase the R square across US equity. And these factors, I just call it here XR for excess return, that's the market, like what we've done in the morning. And XR SMB would be the return on a portfolio that goes long small firms and goes short big firms. So like in the around 1980s, Bunz was the first. There's also a nice case study in Harvard about that. The Bunz, I believe he was a PhD student. He was the first kind of to find that, and then others in empirical research. Usually then you have followers pretty quickly. So they've been finding that all else equal, if you buy a small firm, the average return is higher over time than if you buy a big firm. Then the question is that significant, yes or no? We talked about that, so you have the same problem there. Next question is it persistent? Does it persist? It tended to disappear over the next 15 years. I also mentioned that already. If it's not an equilibrium outcome, then it just was a mispricing. The rationale why it is equilibrium was then what is just rationalizing about it. People were saying small firms have less analyst coverage. If you have less analyst coverage, then markets are less efficient. So again, towards mispricing a little bit. But still, size is part of the Fama-French 1993 approach. And one more thing, if you buy the small firm versus a big firm, we know we have a lot of idiosyncratic risk, epsilon. So to get rid of it, they build a portfolio. Yeah, they would basically take, if you have 1,000 stocks to invest into, they compute the market size of these 1,000 stocks using market capitalization. So what's the price of the stock times stocks outstanding, gives you market cap. And then you have a vector of 1,000 which you sort, and then you take the top versus the bottom. Let's say you take the smallest. Different research does it differently, maybe top 10% or top 30 versus bottom 10 or bottom 30. Fama-French have an approach, you can see it on their website. Most researchers follow that, but in terms of robustness, you also want to see whether it changes, and you will do the same in your problem set. I've mentioned there with Alex Walter, you get some option implied features for 500 firms, and on a daily basis, and you have their returns, and then you also will check where do you set the points, 10 versus 30 versus 20%, what not, and then does a long-short portfolio generate alpha? So it's a very similar exercise than what they have been doing. And like in 2010, when I went to an investor conference at Key Largo from Columbia, and I could hear the hedge funds talk, was a hedge fund conference, this is what they talked about. Long, short, and finding some factors which produce alpha. Yeah? Now the thing has shifted over the last 3 years towards these machine learning tools. So therefore we have both in our program. Both are still heavily used in industry. Okay, so therefore now we will want to use that. Again, one additional connection back. I once said there is no alpha, just undetected beta. Maybe you remember that. There's another example for that. If you work with the CAPM, you might get a positive alpha, but the question is if you control for the other two risk factors, which are now established risk factors, if then the alpha disappears, then it just really meant the alpha that was classified alpha in CAPM was just undetected beta for exposure to small or to value. And I mentioned today in the morning, you see now I start connecting back to help you see the picture clearer. I mentioned the factor zoo. So the factor zoo kind of means instead of the 3 predictors, you have like 300, and they're highly correlated. So the question is now over the last few years, it can't continue like that, so we need to do proper feature selection, both from a data science perspective as well as from an economic theory type perspective. Right. And if you think about this condition number discussion from the morning, there is an analytical must of why we cannot just keep going and add different features. So I also see students sometimes, let's say 2 years ago, when it was rather fresh in different projects, they just had the notion, let's just dump everything in, and if the solution comes out, then we have a solution. Yeah? But good data work is different. So I've mentioned like condition number as one example to really make sure it's meaningful what you compute. Good. I do the IPython notebook, so we can cover two things. It's posted on Ilias. I left a few things blank, so to make it faster for you to work on, but also to motivate you. Sorry. To work on that. Good, Fama-French model. Maybe I should write it onto the board. Good. So we will take one sector. So if you go to Fama-French, if you just Google Kenneth French, you get automatically to his data website where they collect these different factors. And he also collects, instead of single stocks, he's grouping them into portfolios. Yeah, this kind of makes sense because the epsilon is noisy. If we want to learn about expected returns, the epsilon isn't helping us. It's the enemy, basically. And by building portfolios, there's a naive diversification happening, so volatility is down by roughly factor 2. If you can follow what I'm saying, it means you are on the curve, given what we've been teaching so far. Right? So therefore here we are selecting one portfolio, it's the HT, so this is what was called technology, or what was the proper name? High tech. And we ask the question, did high tech pay in alpha in this time period? So here we take the high tech return at time t, we subtract the risk-free rate, and then we check whether the alpha here is significant. Yeah? And in order to check that, we are controlling for 3 factors. So I write it as a sum to save some writing. So let's say I element. What are the 3 factors? The factors are the market. The other factor will be small minus big, so that's the size. And the other will be value, HML. I didn't define HML. So HML is high minus low. You remember case number 1, the dividend yield is predictive. So the dividend yield is predictive for future returns, and also the earnings yield. Both are measures of value, basically. Yeah, we saw if the dividend yield is high, the expected returns are high. And that's something HML picks up. HML doesn't work with the dividend yield, but it works with book value over market value. So if book value is high, it means relative to market value, it means the market prices are relatively low relative to the value the firm has in their books. So remember the footnote of Asnes, also PhD Chicago, where he says it doesn't really matter which proxy you take for value. And that's the way I also think about HML. It just captures that the firm here specifically has high book value relative to its market value. And research has shown that on average, if you buy firms which have high book value to market value, they tend to overperform on average in terms of the realized return. So what is a typical HML firm with a high HML? These are like the cash cows. Yeah, it's like the boring business that provides stable and big cash flows. And low HML would be biotech, or when Microsoft, Google, Apple, when they started, these were like growth firms, and then over the business cycle they developed towards value firms. And so, right. Okay, so we are regressing this one on beta I times the excess return of I, and then we have the epsilon of high tech. Okay, good. And now we want to just implement this regression. Gave us also the chance to introduce Fama-French. So we've stored here in FF4 CSV the Fama-French factor returns. We also, from the Kenneth French website, got a CSV which is called Industry 5, so it contains 5 industry portfolio returns. And out of that, we will pick out the high tech. And we are assuming industry and market returns are in excess of the risk-free rate. So we are assuming. In reality, we should not assume, but check it's the case. I have the feeling here we wanted to not spend time on that. I've mentioned in the morning, risk-free rate in or out, it doesn't matter. But if we make a formal analysis, we should have it in, of course. But it's just for teaching. So we can make a few shortcuts if necessary. Okay, so first thing we do, we want to use the packages. So now the IDE, I already relied on it, or I got used to it. So we just have to import these different packages. So we take pandas, SPD, and we also need the stats models, or we will use the stats models. So import stats models. And we will use a different way to run a regression. So I want to show you another one. So here we will use a .formula.rps.smf. So now we can plug in a formula. So let's see what that looks like if you haven't seen it. Okay, so that's enough for now. Yeah, okay. So now we want to load the Fama-French factors. So I was giving here Fama-French, that these are our x variables. So ff4.csv. File hasn't been found.
No, it has to be tree. The names.
Let's see.
The .env file name is
FF3.
Yeah.
Thank you. Good. Okay, thank you. Good, here's what it looks like. So we see the date is given year, month, day. This is 1, 2, 6, 7. So again, it's daily data. And this is the index. And then we have MER, so that's the market excess return. SMB, small minus big, so the return on a portfolio that goes long, the top, I believe was 10%, but maybe a third. So let's say the smallest, and it goes short the biggest firms. And then this is the same, it goes long value firms, and it goes short growth firms. And this is the risk-free rate. Okay, you see we would need proper documentation for the data. Here we haven't done it for the teaching data, but if you give a presentation and like based on a problem set, every term needs to be defined properly. Because here I have a cheat sheet which tells me what the frequency is. Let me just double check. Oh, that's the thing. That's why we said we assume these are already excess returns. So therefore the risk rate doesn't matter. That's why it was part of the file, but most likely I got the file and I didn't see what's the documentation for it, so I just ignored it. And SMB is an excess return, so the risk-free rate has no impact because you go long, let's say Walmart, and you go short Apple. Yeah? So risk-free rate would be in both returns, so it subtracts off. And this is already market excess return, so the assumption was even correct, but I wanted to state it explicitly. Okay, great. So now we go, first thing we want to do, now here we this is still a string, and we want to convert to string so that Python knows this is really a date time format. We are not really using it here, but you can think about if you want to make predictions or if you want to run back tests and the like. It's really nice if your data has a proper datetime column and then later even an index. So what we are doing here now, as above, I start from the right. We're using the pandas method to date time. So now we have to specify what we are arguing contains a date. So it's our column date. Then we tell what's the format, year, month, day. I just verified. So now it creates a copy of the X date in the datetime framework, and that copy gets assigned to the existing column X date. So let's look what that looks like. So here's what it looks like. Yeah, now we have a date format which Python recognizes. And the next thing now we want to get rid of the X matrix to be indexed by the number of the row, but we want to use directly the dates as being the index. So what we do, we just call X, which is a pandas data frame. It has a method setIndex. So now we can force what do we want the index to be, and we want date, the date column, to be the index. So this is now what we have. Yeah? So now we really have something like an Excel sheet where we have on the columns excess returns, and here we have our time period. Okay. So our X, at least the collection of factors we have, we can add later a constant for the alpha. So now let's work on the Y. The Y, then here industry 5 CSV. So therefore we use this comment indus5.csv. Let's have a look what that looks like. Good. So therefore we've downloaded, starting in 1926, the returns of sectors. So these are sector returns. Here it's for consumer products. We have manufacturing, we have high tech, that I forgot, and then other, I also forgot what the definition is. So we only need the high tech sector. That's the one we are looking at home. You could try the other ones if you like. So we do the same. Then above we are making date the index. Good. So first we are using that string, converted back into a nice date time notation, and then we are setting our date column to be the index. So if we do that, it should look like for our X. Here, right, okay. So one thing to be careful with, we look at the head. So it looks like the time periods are already aligned, but we cannot extrapolate that thought by seeing the observations. Yeah, that's just for you, for your future work. So we will use a proper Python command that is ensuring when putting data from X and from Y together that they are also matched according to the index. And if one is missing, there will be a none value for that. Yeah, this is very important. Could be someone who's new in empirical work. he or she makes that mistake by just saying the data is already aligned. Maybe it is, but maybe is the enemy of great, so we will assume it's not the case and just rely on Python to help us merging it properly. Good. So next thing we do is we are now running the regression. So here I call it FF3 model to underscore, it's the Fama-French model. Here I already have a documentation. We will add a regression constant as the alpha, like in the morning, we've done that. And then we will join the two data sources based on the date column. That's why it was important to have the date column as the index. Good. So the way the SMF works, so it wants a formula. You have high commas, which means you are supposed to use the notation of the column names. So we could say here, take the high tag. So it would recognize it's that column and regress high tag on a constant plus on MER, which was here, market excess return, and also regress that on the SMB column and on the HML column. Yeah, some prefer that, so therefore I wanted to show you that. And what is the data? The data comes from the Y, industry 5, and from X. So therefore, the way we could do that is we say data equals X dot, and now comes the join. So create a copy of the joint set of X and Y industry 5, and the joint set is found based on the index, and both have the same index, but they might have different index values. So therefore the join will create us a copy where dates are perfectly aligned between the Y and the X. Good. Next thing, we are fitting that OLS here, and then we want to print out the results. So like we've been doing in the morning with the CAPM. So let's see, everything runs through smoothly. Yes, it does. Okay. So again, we take the time to properly interpret the output. If I can't make the rolling window regression, then you can do that at home. I have the same frame where you just have to add a little bit of stuff, because I think I rather do the interpretation with you. I think you learn the most. So here's the regression, high-tech using OLS. The objective function was least squares. We had 23,000 data points, degree of freedom model 3, so we have 3 regressors. Still, it's a non-robust covariance matrix. So non-robust standard error, non-robust T, non-robust confidence levels. In the third problem set today, you will have a robust one. And then we have an R-square of 85%. So my question to you, why is it so high? Let's just collect some thoughts. What contributed? Please. On the one hand, we have more regressors. You're right to say maybe. So what can we check whether the maybe becomes a statement?
Because the adjusted R-square is not really that much lower. It's not that big of a factor.
Okay, so we can check adjusted R-square versus realized R-square. Some other idea? Because I had another idea, but I think it's completely leading us towards a similar conclusion. What else? Right, yeah, we can look at the T statistics, which I would prefer, because adjusted R-square penalizes for the number and not whether or not the coefficients are significant. Yeah. So we go to the T statistics slowly, but if I just skim over them, they're highly significant. Again, come back to our 2.29 CAPM. Let's not debate whether that is significant or not. If something is significant, you see here, you have a T of 367. Yeah? So really be bullish in requiring that someone who shows you results shows you, if he says he or she is significant, that they're really significant and not just borderline. But we come and talk about this in a minute. Okay, the R square is so high, we said most likely it's because coefficients are significant. Okay, but you know, there could be a statistics book which says you have significant estimators and still the R square is low. It's not a contradiction. In the finance context, epsilon is idiosyncratic risk. So if a firm or a project, like say like Bitcoin, has a lot of project-specific risk, then the R square should be low. Yeah, I just highlight that. I know from the MBAs in the US, they come from statistics class and they think R square needs to be high. This is what a statistics book usually say, and it needs to be connected to the significance. But I want to show you it doesn't have to be. Right? So therefore, being significant contributes towards the high R square, but I could make a case where something is highly significant, but the epsilon, because it's the parameter sigma square epsilon, could just be large, which is absolutely fine. So there must be something else which contributes to the high R square, which we haven't yet looked at. Okay, there's silence, therefore go one step back. What are we regressing here on what? And try to think about the variables.
We are regressing one market segment on the whole market.
Right, yeah, so we have now a market, we have now a sector return. So then I try to connect back to previous class. What do we know about portfolios? We know 1/n rule in terms of diversification. If we have one stock, the volatility is roughly 50%. And if we pick by randomness 5, this is not by randomness, it's the same sector, but okay. But if we had 5 by randomness, we would already be somewhere lower than 30%. I rather think we are closer to 25%. This is the number of assets in the portfolio. Yeah, so here's high tech, so it's not perfect, so but maybe then it's at 30% or 32%, 35%. But there's diversification happening there. So you see what we've done basically is by building a portfolio, we're reducing the epsilon variation, which mathematically speaking, by building a portfolio, we are reducing the sigma square epsilon, the noise component. So that's a smart move, isn't it? Independent of Fama-French. Because we want to learn about these coefficients, beta and alpha, and epsilon is the enemy. So you want to weaken the enemy, basically, right? And by building a portfolio and by regressing a sector return on the factors, it's easier. What means easier? You have more precision in your estimators, and noise is smaller, and therefore all else equal, R square is higher. Yeah, because we are reducing the variance of the left-hand side. Yeah, so therefore take it as a rule of thumb now, that the in-sample R square of a sector portfolio return, this is even daily frequency, so it's highly volatile, is in this area of 80%. Yeah, so that's just to appreciate, because you will see different numbers. I've shown you, and we will see it again, the machine learning portfolios R squares out of sample 0.1%. So it's good if you separate what are you seeing here. Machine learning is predictive. This is not a predictive regression, it's a mapping, T on T. And this is the in-sample R square and not the out-of-sample R square. Good, then we have this we talked about. If we look at we see what are the units? That also you see documentation could be better or must be better. The units are right now not clear to me. Let me see whether. No, I don't have a comment. But you see, for the full value chain, you get the data yourself. The data is explained there, and then you really write down and make a link. I here got the data from a previous problem set, and therefore I don't know. And I was too time constrained to update the data myself. So I hope you don't mind. The statistics here is kind of the same. Now, what about the alpha? The alpha is significant. Standard T of 6. So it says, given the sample, with 95% certainty, we know the alpha is between 1.3% and 2.5. So it's a big interval still. For an investor, 1.3 versus 2.5, so it's double. It's a big interval. But we can say it's likely not 0. Yeah, so usually also in statistics we focus on significant, yes or no. But now in finance, the second step is how large is the magnitude really? And I would like to boil it further down, but there's too much noise. In the epsilon, when we look at the beta, for example, it's very tightly estimated. Yeah? So the beta of high tech is 1.0. I gave you this rule of thumb. If you don't know anything, assume beta is 1. And the same here. Yeah? It really turns out to be 1. Why is it so tight? Because the standard error is so small relative to the coefficient. So the t-stat is really large. So it's large with regard to the hypothesis that it's 0, so we reject 0. And nicely, the interval tells us really there's little ambiguity that the coefficient is 1.0. So in that sense, you see the high tech, although it's not a long short portfolio, it's just buying, no, I was wrong. It's a long portfolio of high tech, so it has a market exposure of 1. It's like buying an ETF on the market because you have the same beta. But you will differ in terms of the size and the value exposure. If it was a long short portfolio, like if you, like in this upcoming problem set in the future, you build a long short portfolio. If you then regress on the market, you would anticipate a beta of 0 before you go to the analysis. Because long short, the hope would be you're neutralizing the beta exposure. But here we are long only, so we have a full, it's like having an ETF on the market. But in addition, we also see high tech has a negative SMB. It's significant. So how to interpret that? Would that be now, would high tech firms be rather small or rather big? I don't know which firms are in the high tech sector, but I can deduct from that result whether these are rather high market cap or low market cap firms. Now let's write that on the board, since there's a bit of discussion on that. So we have alpha 0.019 plus we have the market. Now we have minus 0.07 times the return on SMB. So it says if our SMB goes up, that guy goes down. Please?
Big market caps.
These are big market caps, right? Because this one goes up if small goes up, and this return is negative, or to be more precise, yeah, let's make it more precise. This guy here, element, okay, it's a positive number if the return on small is bigger than the return on big. And it is a negative number if R small is, if the realized return of the small firms has been smaller than the realized portfolio returns of big firms. And this guy is negative, so it loads negative on the spread R small minus R big. So therefore the minus in here reverses that. So you see the negative says whenever big firms overperform, the sector overperforms. And therefore you would deduct that these are rather the big caps in the high-tech sector. What we've just been doing, this anti-interpretation exercise in industry, this is called, or it might be called, something related to, for example, here, style investing. Why style? Well, because you have an asset manager, and the asset manager is reporting returns to the client or to the public. And it does, let's say, to the public, so it might not want to reveal what it's doing. But if we have a time series of his or her return, and we get a time series of these factor returns, we run this regression, so we can uncover kind of which style did the manager follow. Did it like to buy big firms relative to small firms? Yes, it did, because this coefficient is significant, minus 15. So if the investor, the asset manager, tells us he is stock picking small firms and that's his or her skill, there's a contradiction there. What he or she says is not true, or needs to be better explained. Because the portfolio return shows clearly that there is positive exposure to big firms. So if anything, he or she might short small firms, but not go long. All else equal. Yeah, so style investing, or maybe you could call it factor exposures. That might be another term. Factor exposures. Yeah, but I kind of like this one, style investing, better in terms of summarizing what these guys are doing. Okay, now same in terms of value, HML. If I continue, we have HML is negative. So what do we have? We have minus 0.35. The t statistic is also nicely significant, minus 17. So again, there's no doubt that this guy is not zero. And if we look at a confidence bound, minus 0.8 versus minus 0.7, so it's somewhere in the area of what we really did estimate. Oh, I was in the wrong. Minus 3.6, minus 3.4, so somewhere 0.35. It's really accurately estimated. And this is now the return on HML. Yeah, so what this return is, HML is the return of value minus return on growth. And like above, we have a negative sign here. So therefore, we see high-tech loads on growth firms, as you would anticipate. There's no cash cow in here, but maybe there's Apple, and you say Apple is a cash cow by now, yes. Yeah? But in the classical way, so these are high-tech growth firms. They have high market value relative to book value. That's how Fama-French identify them. Or we would find they have a low dividend yield. You're pricing in high expected dividends in the far future. Because you think, I like to think about biotech, they have a few patents, they don't generate any revenue now, like BioNTech prior to COVID, and then boom, something happens and there's an explosion in revenues. And then the stock price goes through the roof. Okay, so what we see, style investment time, the return of high tech tends to be market neutral. Not market neutral is the wrong word. No, market neutral is made of zero. So it tends to be moving with the business cycle, like the market does. But in addition, it tilts towards big firms and growth firms. Good. So if you now wanted to compute what's the expected return on the high-tech sector, you run this regression based on that data. You say, well, it's the alpha plus the sum of the three betas times the expected returns of expected excess returns. So you see now why we would then need on top a model to compute these expected excess returns. But for now, we'll just take the sample mean, for example. Yeah. And how to interpret this alpha? Well, tech is always good. Yeah. So what was the time period? Was it 1926? Yeah, 1926. I mean, you don't do wrong. Yeah? If you have a well-diversified tech portfolio, I think it also applies to today. We have to think about the sample is not infinity, so still it's a sample selection that we have here. How significant was the alpha again? Yeah, 6. Naja, 6 is not 300. Yeah? So that's also that was a sentence one should confront an industry person with during the workshop. 6 is not 100 for the alpha, because they would be happy to have an alpha of 6, T statistic. Good. So therefore, insights, the CAPM beta, yeah, it's roughly 1. Yeah, so it's like moves on average like the market. Please. Yeah.
One when the tech sector is just a little bit of the market, then
yeah,
it doesn't represent all of different sectors
yeah,
that are in the market.
right. So the question, why the beta 1, given I exaggerate, given that the high sector is far away from the market. That's a very important question also for things like trading and hedging. If you have the market has a beta of 1. That's clear. That's exactly where your question is after. But you could also have other instruments that have, how does the return of high tech, to be precise, how does the expected return of high tech change if you change the, maybe I do expectation out for now, but it doesn't matter, but maybe it matters. So I stay conservative right now and just do what the regression tells me. How does this excess return change if the market excess return changes? This is really what the beta captures. So therefore it could really be that although this is really something different, the partial derivative is still 1. And that's why I was plugging in the expectation here, the way to think about that. Because the reason realized returns are different is then also the other factors, but more importantly, it's the epsilon. And that's why if it's only part of the market, to your question, it means the epsilon here is far different from 0. But the way we identify the beta is in terms of the partial derivative. So how would the expected return on the left change if the expected market return were to change by 1%? But we also use that in practice for arguments on the realized returns. Yeah. So therefore the beta, I would also say, is the partial derivative of how does the left-hand side, so the high-tech excess return change if there's a change in the market return. And that is used for hedging, for example. So let's say you have a portfolio, what industry is doing. You have a portfolio, and let's say it has a beta of 1. I don't even need to know what's in the portfolio. I don't care right now. Yeah? But I need to know what's your beta. And let's say it's Friday, and you are afraid that once market closes, there is news coming in which affects the market. So you don't care about news which is diversifiable. in my example right now, because I have this beta of 1 and I'm benchmarking my portfolio against the market, but I'm afraid there's market news coming and I can't trade. So what the traders then do, if they want to protect, they are going into the futures market. And in the futures market, you can buy something which is also different than your own market portfolio, but at least it has a beta of 1, and it's a leveraged position. So we don't do futures here. You can go in the derivatives class, for example, right? They're teaching that. But I just want to reveal this intuition that the futures is a leveraged claim on the market, if you take a market futures. And what then the trader is doing, the trader says, what is the beta I would like to have over the weekend? Yeah, so if the trader is really comfortable, the trader says, no, or the investor, I just like my beta. But if the trader is really scared, something might happen, so I'm not talking about scared, trader has subjective evidence that the probability of something happening is large. So then over the weekend, the investor wanted to reduce the beta without selling the portfolio. Naively, we would think sell the portfolio on Friday and buy it back on Monday. But because of transaction costs, this is really expensive, you can't do that, right? And then try to go to your board and say, I just liquidated $1 billion, but I buy it back on Monday. You know, I mean, you create a crash by then. This doesn't work. So the smart way, and it's anyway the only way, then you go to the futures market. They're highly liquid, and in the futures market, since they're leveraged, you maybe just need 1/10 of revenue to get your beta completely to 0, but you don't want that to 0 completely, yeah? But you can lower it. And therefore the beta, knowing the beta exposure of your portfolio is important also for this risk management, because you can neutralize for a short amount of time the risk of these variations, which work on average. Yeah? They work on average, and it will also work at least a little bit on the next realization. Good. Okay, so we saw big firms, business model is more growth, loadings are all significant, and 85% explained. Yeah, we talked about that. Which percent is systematic, diversifiable? So 85% is systematic, 15% diversifiable. So you already see it's a pretty diversified already. But now, relative to the Fama-French portfolio. So one could redo the calculation. You can do that at home. If you get rid of the Fama-French factors, you just regress on MER. Because for the argument systematic, idiosyncratic, one needs to be careful now. We talked about that when talking about the CAPM. And MER, market, was the only risk factor. Right? And then we have nicely this intuition, I hold the market, and now I put something in, and only the systematic part contributes, idiosyncratic diversifies. What to do if I have multi-varied factors, here 3? Well, the way industry interprets that is you use the 3 factors to capture systematic risk. And in that sense, my saying was correct, that 15% would be diversifiable and 85% is systematic. So you see that this high-tech sector doesn't have much idiosyncratic risk. It's, good. Any questions so far? Any comment? Then maybe we still have some time. Yeah, 20 minutes for the for this rolling window CAPM. So rolling window CAPM is interesting because the beta here is a constant, but markets are dynamic. So ideally we would like to have a beta estimate in every point in time. There are firms who are selling such estimates, and you can do complicated estimation approaches. I think even we have it also in the program. Or you use something which provides you very similar results, a very similar estimator, but it's far simpler to implement. And it's also a good way to benchmark against more complicated approaches. And this is a rolling window regression. So it's very popular in finance. And let's have a look here. So there are people in corporate finance, they might ask, why is the beta time varying? Yeah? Because they think about beta as the business model, or it doesn't change so frequently, which is a point. But on the other hand, if we think in terms of how is beta estimated, what's the estimate of beta in this regression? It's covariance over variance. And do we have evidence that the variance moves across time? We haven't yet talked about, but we will have a risk management part in the course. Let's see, we could look at, let's say, I don't know, let's try VDAX, never looked at it, I hope it works, VDAX time series. So let's see, I talk when I see. VDAX course, okay, what's that? Here. So let's oh, this is okay, Durchschnitt, but I want the longer time series. Don't know why it doesn't give me. Yeah, okay, this is at least for 1 month. VDAX, so that's the average option implied volatility for a DAX option. Yeah. So let's, simplistically speaking, this is the market's price, therefore the market's estimate of the volatility of the DAX. And it's clearly time varying. Yeah, maybe not much. You could say, well, this all moves around 20. Yeah, so let's take another one, something I have looked at more. Let's say the VIX, and we want from Yahoo Finance. So the VIX is an analog, but it's for options on the S&P 500. So that is an observable measure for volatility. It doesn't require any time series methods. It simply extracts volatility from options. And it's clearly time varying. Right? So that was what I was after. Why was I after that? Rolling window, because I wanted to think about why is beta time varying? Because beta is covariance over variance of the market. So if I look at just the variance of the market, I see it's really time varying. Yeah? And now that we are here at the picture, I love looking at volatility of the market, or in general. Here you see financial crisis, 2008. You see COVID here. Right. Yeah. Now, it would be nice to also show you the option implied covariance, but that doesn't exist, unfortunately. And the reason is, and even that is in our bachelor's course here, we will have in the bachelor's course, I think at least 2 weeks, where we talk about the theory and then also how it's done, and you have a problem set on it, how to extract option implied variance from an option. Yeah, we don't need to know option theory for that. It's a numerical thing that we rely upon, and a Gordon growth model in a way, so we are connecting back. And we will show you with code how to do it for the variance, and you will have a problem set where you redo that for skewness. Yeah. And what we are relying upon here are tradable options on the index. If we wanted to get a covariance, we needed options on the index and the firm we're interested in, but that is not traded. But there has been research in 2014 on how to approximate that. So I can tell you the covariance as well as the variance are both time varying. yeah, and they are strongly time varying, which of course also makes the beta time varying. And the simplest way to get time variation in the beta is by running these rolling window regressions. And this is what practitioners would do. They would not run a regression over 200 years or what I did over 60 years or the like, but they would rather go with shorter periods. Let's collect some thoughts of why, statistically speaking, it would also be good to use rolling window relative to, I exaggerate, a 100-year period. Yeah, so you see, you learn a lot in this course about transferable knowledge.
I think the errors are distributed more evenly in a shorter time frame.
What the epsilon is?
The epsilons
Are more?
distributed in a similar way, if not getting such a large. But that's, I mean, that's
That is one thing.
That the beta is constant. So
If you have this IID assumption, the IID is more reasonable for shorter periods. I would accept that. Anything else outside of the epsilon? The beta is assumed to be a constant in the regression. But what happens if you have regime shifts? Yeah? We know beta's time varying in reality. So what we estimate here is like an average of the time varying beta. So the longer the time series, the more you just really get an unconditional average, which might be completely off from the current beta. So let's say the beta looks like a sine function. Yeah? So maybe over time it moves like this. If you run a regression from here to here, so let's say t, this goes to infinity, yeah? And this is 0, then the beta you estimate is 0. Although I assume the true beta follows the sine function here. So therefore you really see, this is like regime shifts. Yeah? You have positive beta, highly positive, strongly negative, different regime. Could either be the firm, this changes the business model, or once I do the data work, I'm not too much anymore in the business model, I just care about the estimations. So for some reason, correlation has changed. For whatever reason. I don't even know what's the frequency of my beta here. And therefore, if I go with rolling window regressions, I could hope, if this is my regime, my rolling window, then I get the average of this guy, yeah? So maybe the average then is somewhere here. Yeah, and if I use this as a rolling window, maybe my average then is kind of here. So you see, rolling window really makes sense to use. What speaks against rolling windows is I shrink my sample, so I will reduce the t-statistics. Therefore, I need to keep an eye on whether the significance is still high enough for me. So I will not be able to, but I can make a start. So here I'm reading in another data set, I call it data 2. Here's what it looks like. I have the T-bill, Microsoft, S&P, GE, Ford. Closing prices. I want to show you something.